Hey everybody, this is David Murphy, President of the Marshfield Medical Center Credit Union, and welcome to the Credit You Deserve podcast. In this podcast, we will cover relevant topics that impact your personal finances. You will walk away better informed about the basics of personal finances, with tips and recommendations you can incorporate into your own daily lives. We will also inform you to the latest developments in the financial world and the impact they may have on you. You work hard to take care of your finances. Isn't it time you get the credit you deserve? Welcome to the first episode of our podcast. My name is David Murphy. I'm the president here at Marshfield Medical Center Credit Union. And we thought that we'd put this podcast together to share some financial tidbits with our members and with those across the country who are just seeking some reasonable and personal financial tips, especially in today's day and age with the ever going changes that we are experiencing within the markets and whatnot. So today I am joined by Jerry Litwaitis. Jerry is our VP of Lending. Do you want to give a little background about yourself here?
Yeah, absolutely. I've been at the credit union since April of 1992. So I just celebrated my 30-year anniversary here. Seen a lot, and I guess that's what we're going to talk about today, some of the changes that we've seen throughout the years at the credit union stuff. So
that's right. So I like to rib Jerry a lot because Jerry started in 1992. I was born in 1986, so he's a little bit older than I am, so I like to kid him on that.
And he does. He says I'm old, and, I am old.
Yeah, well.
You're only as old as you feel, is that what they say?
Well, that's not good. That's not good. We'll just leave it at that. So we thought that we would start or have the conversation today in regards to the history of rates in our economy. So recently, interest rates have been going up. You may have heard conversations that the Federal Reserve has been increasing the Fed funds rates a number of times over the last couple of months, and what the effect that's had on lending rates, whether it's mortgage rates, your car loan rates, or any other products like that. And for our generation, we may be thinking, wow, rates have gone up from 3.5% to 5.5%. This is astronomical. I can't believe that. There's no way that rates have ever been this high. And so we thought we'd give a little bit of context of what this rate environment actually looks like in the grand scheme of things. And so we're going to start with the 80s because that was a pretty tumultuous time and work our way through modern day just to give some context again and background as to where the economy was at that point and what has happened in those years since. So with that, we'll get started. So again, starting in the 80s, it was a time of stagflation. Stagflation is basically a period of inflation or high inflation, but interest rates continue to drive up. And so it's really the worst case scenario as far as an economy is concerned, because it means that it costs a tremendous amount to buy anything. It costs a lot to borrow money, so it's really hard to spend your money on things. It's hard to afford your daily goods, whether it was gas at that time. You may have seen the pictures. You were probably a little too young to remember
I was
this.
That was not in my wheelhouse at that point, right?
But the people who were stocking up on gas and they were rationing out gas at the gas pumps in the late 70s and early 80s because of the inflation that was being experienced at that time. And so heading into 1980, the Federal Reserve had increased during the year of 1980. They increased the Fed funds rate to 20%, which is the highest that the Fed funds rate has ever been. Mm-hmm. And so thankfully it's not that high now. But just to put some context, if you talk to, so if you bought a house in 1980, you figure that today you'd be at least in your 60s or 70s. So if you're talking to your grandparents or someone who's a little bit older, they're going to tell you that, when they bought their first home back in 1982 and they paid an interest rate of 14%, and that was a really good rate on a loan.
Correct. And they say that was an excellent rate.
Yeah.
Happy to get that 14%.
Yeah. And so in today's mind, you're thinking, well, that's unfathomable. How the heck could you actually afford to buy a house if, it's at 14, 15, 16%? Granted, we understand that the cost of houses back then was not that high. There's a little bit of give and take from that standpoint. But so I know you went to college in like the mid 80s.
Correct. Yep.
Do you remember did you take out car loans at that point, or did you have to take out a loan for schooling?
No, well, just the student loans we had to do so. And I guess my biggest recollection of that was my freshman year in college. It was 1987. And I was sitting in my economics class in October, I got to get the date right. Black Monday, October 17th, I think it was. I may be wrong on that date, but it was 1987. And it was one of those, do you remember where you were moments? And I do. I remember it actually came over almost like an intercom thing.
Really?
Yeah, it really did. In Eau Claire, and they said that the market had dropped 20, I think it was 22%, which it equaled out to about 509 points in one day. And that was just shocking. Just to put it in perspective, like today, or I think it was 2 years ago during COVID in March of 2020, the market dropped, or the Dow Jones Industrial Average dropped 2,997 points in one day. So, and that was huge, but
Right.
it's just how much fluctuation it was. So that's what I remember most about the 80s. I know I heard about the high interest rates on vehicles and homes especially, but you also have to remember that you were also getting 7, 8, 9% on your savings accounts and your checking accounts and your certificates, right? So that's where I remember, because I had a savings account opened up, and I'm like, oh, it stuffed some money in there. Yeah, I'm getting 8% on my savings account. Well, we have not seen that in a while, have we?
No, we have not. The times have really flipped from that standpoint, because nowadays you can't earn anything on savings accounts, but you're paying very little on your loan rates and whatnot. So it was a good time to be a saver back in the 80s.
Yes.
And be a spender now, really, if you want to look at it from that standpoint.
For sure.
So yes, as we ventured through the 80s, one thing that we saw in the financial services industry was there was a lot of deregulation that was going on at that time. And we won't turn this into a political conversation at all, but that was just the reality, was that there was some deregulation that was going on. So because of the changes that more in the banking sector and the savings and loan, or the S&L sector, saw, there was actually the 80s through the early 90s saw the highest number of bank and S&L failures in any period in history. And a lot of that was due to banks as rates were starting to come down throughout the 80s, banks were grasping to continue to add high yielding loans into their portfolio. Well, if rates are coming down, the only way, I suppose you could say, to continue to add higher interest rates was to take on riskier loans. And so yes, a lot of managers were, their performances were tied on financial performance. So a lot of them continued to add riskier loans. And because of the deregulation, there wasn't as much checks and balances in place. And so we saw a lot of bank failures that happened in the 80s. And to touch on the S&L crisis, if you Google S&L crisis, you'll actually read about this. But savings and loans back in those days were regulated by the federal government to basically, in quick synopsis, they were forced to book 30-year fixed-rate mortgages at a certain rate, and they only took in savings accounts. And so what was happening is they would book rates, for the 30-year fixed-rate mortgages, but as rates were coming down, people were refinancing those at lower and lower rates, but they were paying savings rates that eventually were higher than what they were earning on the loans. And so simple math says if you're paying out more than what you're bringing in, eventually you're going to start to lose money to the point where you're not going to be solvent anymore. And so that just exacerbated the issue within that sector, and a majority of the S&Ls at that time went away as a result of that regulation.
Yeah, I believe there was, I did a little research because it was, like I said, a little bit before my time in the financial industry, but it was $400 and some billion in losses that the S&L industry took on. Well, and then again, of course, the government with the programs they started up, and then they did start. That's when the regulations started, and they started moving more towards that way for a little bit.
Yeah, and this theme about government interference, if you want to call it that's probably not the right word, but this will pop up again later, and I'm sure many of you will know when we're talking about here. But so as we ventured from the 80s into the 90s, and this is where Jerry will be able to lend some personal experience, we still were at significantly higher rates than we are today.
Correct. Yep.
I remember I had a certificate when I was like 4 or 5 years old, so that would have been right in the 1990 range. I was still earning 9% on that certificate at that time, which, of course, that's a really good rate for a saver.
Yeah, excellent.
But the loan rates at that point probably were still
in the double digits. Yeah, they were still in the double digits. I'll give you, I guess, that's what I'm here to talk about. I'll give you some examples about the rates that I've seen. Again, I started in April of 1992, and I started with consumer loans. And, obviously this is jumping ahead a little bit, but we ran a vehicle loan special. in 1994, and it was the interest rate was 5.94%. 94 obviously to go with the year 94, and we did tons of loans, tons of. I even had members asking me, "Oh, are you going to do another deal like that again?" That was great. We booked a lot of loans. Now, if I told you today that your rate's at 5.94%, most likely you might go somewhere else to look at your financing because it's so low. Also about that time, the late 94, early 95, I started getting into mortgages. And I actually did write a handful of mortgages in the 9 percentile range. But then shortly after that is when rates started to fall. And that's where we kind of saw what I think most people say is the refinance boom. Because there were still people in the 80s, late 80s, and still early 90s that had double-digit interest rates. And people didn't want that. So when the rates fell, they started to refinance. I remember during that time period, the mid to late 90s, I had one member that I refinanced their mortgage 3 times in 1 year. So, and then of course you have the closing costs that go with that, but they were dropping their rates so much, basically 3%, from the beginning of the year until basically when they did at the end. That was enough to cover that closing costs. So it was certainly worth it. And we did a lot of refinancing, and that was pretty much our entire portfolio. The other thing that we saw at that point was that I think this was the beginning of the housing values increasing. We saw quite a bit of that. Again, reaching back from my experience, again, this was more maybe somebody that refinanced in the mid 90s and, weren't really following too much. And then we're getting into the late 90s, a year or year and a half, 2 years later, they would look to refinance again because they could save 1%, 1.5%, 2% on their rate. Well, it was funny because we would look at that because a big thing now is value. We got to look at the house value. How are you going to do it? Well, it got to be such common practice that I would just look at the value and I would just add 5% per year.
Wow.
And it was right on. It was, well, I shouldn't say right on, but that was a very good indicator. You would just say, okay, well, and that's doing nothing to their house, just normal appreciation, 5% a year. And you'd come out and it'd be right around that area. So quite a bit different than today, but I think that's something that kind of led up into what we're going to talk about here shortly with the housing bubble and stuff.
Yeah, absolutely. Well, and, going through the 90s, so the credit union here, we started offering mortgage loans in the early to mid 90s.
Correct, yes.
So we kind of got in at a good time because while we maybe avoided, what we were seeing in the 80s with the double digit rates and whatnot, by the time we got into it in the mid 90s and the rates were starting to come down, I think that's what really the credit union really took off at that point, just from a historical standpoint, because more and more people said, oh, well, now I can not only do my car loans with the credit union, but I can also now do my home loan. Correct. I believe we started out just doing second mortgage loans initially. Well,
I think to get our feet wet, they were just second mortgages, but that was really tied in when we started doing a secondary market lending. Okay. Just because we didn't have the reserves to be able to keep a lot of in-house mortgages, I guess reserves, assets, whatever you want to call it. But going with the secondary market, you could book a loan for $90,000, $100,000, $150,000, whatever the case may be. It'd be on your books for a short amount of time, and then you would assign it to a mortgage company. So you could flip that money and still have that extra $90,000, $100,000, $150,000 to use again. So that's why the secondary market was really attractive to us. Attractive for us. We could flip the money pretty easily. It'd only be on our books for maybe 2 or 3 weeks before we got funded, so we could use those funds again for another loan. So that allowed us to help more people, because instead of concentrating all that money into a couple mortgages and then being stuck, we were able to, as Jerry put, we were able to flip that money and help multiple people from that standpoint. And because of the refinance boom, there was a need to help multiple people, because yes.
Pretty much everyone that we were able to work with at the time, they qualified for better rates, as rates continue to come down.
Correct. And I also want to touch on, with Dave, when we talked about the housing values, that's also when the interest rates were just starting to decrease. It was more the late 90s, but into the early 2000s. Again, during that time frame, I used to tell lots of people, because the rate lock was the big thing. You had to lock that rate in, and when you locked in, that was it. If rates went up, great, you got that lower rate, but rates were falling, you couldn't undo that lock and get that lower rate. So there was a lot of not pressure, I would say, but members were concerned about that.
Sure.
So I came up with this little saying, which is funny, and I think I know we've talked about this before, but I would tell members, they ask me what should I do? Well, I would never tell them what to do, because if they lock and rates went up, well, I was a bad guy. If they locked and rates went down, or I should say the other way around. If rates went up and they locked, hey, that's great. I gave them great advice. But if rates dropped and they locked, they'd have a higher interest rate. But I used to tell them 8%. Great. Nothing to write home about, but it's a good rate. 7%, fantastic. You should be very, very happy with that. Anything in the 6th percentile range, you won the lottery. You should be jumping up for joy, doing, jumping jacks. Hey, you just got yourself a fantastic rate. Don't think about refinancing. Well, obviously now, I believe the 30-year fixed rate today is right around 6 or 6 1/8. And again, part of this is people are like, oh my gosh, that's high.
Yeah.
For the times, yes, but there was a time where that was a fantastic interest rate.
Yeah, it's pretty crazy. Well, and as the economy took off in the 90s, after like the Kuwait War and everything, the Fed funds rate ultimately dropped. I think by the end of the decade, it was in the somewhere between the 2 and 3% range. And then, so again, for us youngins here, we probably don't remember or very vaguely remember the Y2K scare, which was a huge thing at that point in time. So as we left the 90s and, it was a brand new century and decade and millennial and all that kind of stuff. But the Y2K thing was a huge thing. Did you see, was there a lot of concern like on a loan side from people or like with rates and whatnot? Did that have any impact?
It was just concerned about everything. The biggest thing was just the technology. It wasn't necessarily, so to speak, about we were worried about it was going to affect the rates. It would have affected the rates eventually. You have technology that's not working, or it's just because the Y2K bug is going to, make your laptops and everything else just, die. Yep. Sure, it might have an effect on the market, which would then eventually have an effect on the rates. But yeah, there was a lot of planning. I mean, you had to have the Y2K program in place. You had to look at all these different things, whether your program was a critical program or non-critical where you could do business without it or you could do it manually. It really beefed up. And again, going back to the story, excuse me, I remember on New Year's Eve, December 31st, 1999, we ran shifts, the management team, to come into the credit union to make sure basically that the lights were on and the fax machine was working and the computers were still running. And I did draw the shift at like 12:30. So I did come in, undid the alarms, looked around, and it's like, okay, nothing's going on. It looks like it was okay. And ultimately, excuse me, as everybody probably knows, nothing came about of it. Thankfully, right, because they said it could have had something to do with the digits, the 1 and the zeros and things like that. I don't really know much what it was, but it really was nothing. But there was a lot of preparation for that, a lot of time and effort and money spent trying to get prepared just in case. Yeah,
that was probably one of the biggest non-events that was an event, really.
Correct. Yep.
Ultimately, thankfully, it didn't have any impact on the financial services industry or whatnot. But
correct.
So we got through Y2K, and then of course 9/11 happened in 2001, and that had a big effect on the markets as well.
Sure.
And so I don't know. Do you want to talk a little bit about what the first half of the decade was? Because then we'll get into the fun part after that. But as you touched base on, we started to see home values start to skyrocket, maybe as a way to put it, in the late 90s. Did that carry through then to the early 2000s?
Yeah, it did. The housing values continued to go up. As I stated earlier, you can almost stay 5% a year, and that's with no improvements, no home improvements, just basically normal appreciation. And the rates continued to fall. They were still kind of edging down, and then you'd have a little bit of time where the rates would go up a little bit. But, like I said, coming out of the 90s, that was, kind of an economic boom in the 90s. Everybody was doing well. I believe we went from a government deficit to surplus.
Yeah.
So, things were really rocking and rolling. And Actually, I would probably just characterize, other than obviously what happened with 9/11 and stuff, but, from the economic standpoint, it was still, feeding off of what happened in the 90s. Things were still going pretty strong. Rates were, would edge up, but it wasn't really, it didn't really affect the consumer.
Do you know range-wise where home loan rates were at that point?
They were in the six, I would say the mid six to mid fives.
Okay.
Range at that point. So it was still, like I said, again, going back earlier, that fantastic rates. But yeah, they were between 6.5, 5.5 is where the 30-year fix was.
Okay.
Generally.
So from a rate standpoint, similar to what we're seeing today, obviously the
Correct.
context of what where we were at versus where we're
Correct,
at then
yes.
is a little bit different. But
Yes.
which leads us into the fun period known,
Yes.
or that leads into the Great Recession. So in the mid 2000s. And we saw this a lot more with the banking counterparts, but there were credit unions and credit union partners out there that, few and far in between, thankfully, but that fell victim to this as well, or that were doing this. But we saw a little bit of a shift in the oversight, I guess, if you want to put it that way, as far as home loans and mortgage lending was concerned.
It's a nice way of putting it, yes.
Yeah, we'll try to keep this PG as much as possible. So there was a lot of loans that were approved and pushed through because it was just the thing to do. That everyone was making money off of it. Home values were continuing to go up. So from some banking standpoints, what was the risk that you were taking on? So mid 2000s, rates were still very attractive considering the times. And so a lot of financial institutions were continuing to book and push loans to secondary market.
Correct,
or
yep.
wherever they were booking them at. And then...
Yeah, and then the bottom pretty much fell out is what it amounted to. Just to piggyback on what Dave is saying, most banks and financials were pushing mortgage loans for anybody. You started in the late 90s where it was the American dream to own a house. People kind of got on that bandwagon. Well, that's all well and good, but you don't need to own 2 or 3 houses. The standards did unfortunately relax a little bit, so people that really shouldn't have had a mortgage for that dollar amount. I'm not saying they couldn't have qualified for a dollar amount. They were getting qualified for much higher dollar amounts than they should have been, and that's kind of where it kind of started to fall apart because there's an acronym out there that they used to call ninja loans, and it's basically no assets, no income, and basically all that means is. In our case, a member. Now, I want to be straight with this. We never did any loans like that whatsoever. We maintained our normal, fairly strict underwriting standards. However, most places in these ninja loans are no income, no assets. Basically, the member, or if it was a bank, a customer at that point, they would fill out an application, and whatever was on there, that's what the bank took. They didn't verify anything. So you could literally go in and say, okay, I'm a teacher and I make, $650,000 a year, and they would just go with that. They wouldn't verify. They wouldn't call your employer. They wouldn't send out a verification. It got to the point where it was just they wanted to make money.
Sure.
Is what had happened. So they were pushing through as much as they can, and then basically the industry had all these loans. So what they were doing is they were running out of the A paper loans, so to speak. So that's when subprime lending came in. Mm. So basically what they would do is they'd get individuals that necessarily didn't qualify for mortgages, had lower credit scores, or wasn't on the job that long, or didn't have a down payment, and they would give them a loan, and then they package those in with those A papers. So, and then they would get sold on the secondary market. And that was kind of the unraveling of it. They just kept doing that, and pretty soon they had all these subprime loans. So they stopped packaging them in the A and B paper. And they just started packaging them by themselves and selling them. And you have a couple that says they make, $650,000 a year. They bought a $1.2 million house. The housing crisis hit where the values started to plummet on the houses, and now your house is worth $800,000. You're upside down that much. Plus, a lot of these people took out interest-only loans. So they would take out a 30-year fixed rate, they interest only for the first 10 years, which was fine because then at that point they could barely afford the mortgage, but they could still afford it. And then when that interest-only term got up, well, now you have still had that $1.2 million loan that you had to finance now for 20 years.
Right.
Because the 10 years of that 30 is already gone. Well, your payments were just getting astronomical. So going from where you could barely afford it to now can afford it.
Yeah, so it's really living in the moment more
that's
from
exactly
like a
what it
financial
was.
institution
Yep.
standpoint, because it was like, well, let's just add these loans to the books and
Yep.
we'll kind of kick the can down the road and worry
Correct.
about it when it comes to light, and it did come to light.
It did come to light. Yeah, it was just a domino effect. I mean, because you can go and, everybody knows about Bear Stearns having their issues and Lehman Brothers filing for bankruptcy, and then AIG came in, and everybody's like, well, they're an insurance company. Why would AIG have a problem? Well, they wrote a lot of private mortgage insurance for these mortgages, which is something that's required for most individuals if you don't have a 20% down payment. Well, nobody had. They were borrowing 100, 110, 120% of the value of the property. So AIG then was insuring all these mortgages. Well, these mortgages were going bad. They were suffering losses. So as I stated, it was just a terrible domino effect.
Yeah, so once the dominoes fell from the housing crisis and the Great Recession took place, rates plummeted because, of course, the economy just fell into shambles, and we still to a degree see the ramifications from that, and that's been 15 years already now. But so rates, going into that, we're probably still in the 5-6% range.
Correct. Yep.
And then when the economy fell apart in 2007, 2008, 2009 standpoints, of course, then the Fed. So the Fed's role, so to speak, is to monitor inflation, but kind of monitor economic growth, make sure that it's growing at a reasonable pace without in setting like the inflation that we're seeing right now or whatnot. So in order to spurn lending and economic stimulus, they dropped rates down to what at the time was being deemed as just a short-lived phenomenon. But as we saw, once we got through the 2000s and got into the 2010s, that low rates was pretty much the norm for the 2010s.
Correct. Yeah, they were pretty much here to stay for quite a bit.
Yeah, and so I started at the credit union in 2010, and I was 2 years out of college, so I didn't really know. To be honest, I didn't really know much about what's going on in the economy standpoint, which is kind of bad to say, but. So after a couple of years of kind of looking back at the data and just trying to grasp what the heck was actually going on, and then trying to put that into context of like, okay, well, what does this mean for the future and whatnot? So I didn't experience any of these higher interest rates. As soon as I got into the credit union, it's like, well, Fed funds was at 0 or 25 basis points or whatever it was at. Mortgage rates were in the 3s. Maybe in the 4s, but I don't know if they.
No, they were. There's some people that got 20-year or 30-year fixed rates that were in the high 2s. Yeah. So I think an average would probably be in the 3 percentile range, maybe some low 4s. But yeah, they're fantastic rates.
But so that's the environment that I know. If you've graduated from or you bought your first house anytime after like 2008, which again, so I'm 36 years old, so that'd be like my age and younger probably. Again, you've never lived in a situation where you've had to borrow at rates that are where they were at, 5, 6, 7%, which was, again, the norm at that time.
Correct.
But because of the economic situation that we found ourselves in the early 2010s, interest rates were kept artificially low, I would say. But I don't know that there was a time during the 2010s where the Fed really had much control over that. I don't think that there was a time where they could have really raised rates and not killed the economy, because it was already hard, going through those times. And yes, there was still, people were starting to come out of it maybe in the mid 2010s, like 13, 14, 15, but it wasn't great. After the Great Recession really had.
Yeah, it had a profound impact, and like you said, long lasting.
Yes.
It wasn't just getting those rates down to 0 to 0.25% just to kind of get us out of it for 6 months of the years. I mean, we went 15 years where we had very low interest rates, and it was just, it's strange because you thought, okay, this should fix it. We'll kind of move out of this and it won't be a problem, but it just didn't. We just didn't move. The needle did not move at all. So it was something else. And what's funny about that is I did look. I just say I'm not a wealth of knowledge. I did have to actually look this up. But during that decade up to 2010, so from 2010 to 2019, that is the only decade in American history where we never went through a recession. That's strange. I mean, to me, it's just like, you always have your checks and balances, and when it goes up, it comes back down. You got your, the bull market, the bear market, as they say, but that's strange. 10 years where we never had a recession. It was just because those rates were so low.
Yeah.
And I think the problem was, as you alluded to before, I don't think there was much the Fed could have done because every time they talked about lowering or raising the interest rate, the market would panic and the market would drop 4, 5, 6, 7, 800 points in a day, and everybody would get freaked out. But so I think it was just they were their own worst enemy, so to speak.
Right.
They did what they thought was right, which I believe they needed to do, but it was artificially stuck there for too long because every time they wanted to do something, then bang.
Yeah, speculation has a lot to do with that.
Correct.
Whether it is the stock market or what the Fed's doing, and so you'll see it, throughout the time frame between Federal Reserve meetings, for example, and whether it's Jerome Powell or one of the Fed governors comes out and just does an interview. And you'll
Yes.
if you watch the market during the interview and even shortly after the interview, anything that's said during that interview, even if it's speculation or if it's a personal opinion on what that governor or that individual thinks the Federal Reserve should do, just watch the impact that has on the stock market. Because as soon as they say something positive, the market will go way up, and as soon as they say something negative, the market will go way down. And they're not even doing anything. It's just, well, I could see us, raising rates this much.
Yep.
Here's the effect or whatnot. So speculation really has driven a lot of this.
It does, and that's the reason why I think we saw those lower rates for that time period. Part of the reason,
Mm-hmm.
obviously, we didn't get out of the the recession took a while, and as you stated, we're still feeling the effects of that, and I think we're going to feel it for quite a bit yet. But things were just starting. You get out. We got into 2018, 19. Rates started to rise. They were able to get over that. They were starting to rise, and then
COVID hit.
COVID hit.
Because I'm glad you touched base on that, because that's where I was going to go next, is that we see what rates are doing right now and what the Federal Reserve is doing. But if you go back 2.5 years ago to that January, February, March of 2020, yes, the Fed was doing the same thing they're doing now, just not at the pace they were doing it. They were starting to incrementally increase rates, which meant that I think before or going into March, I think our interest rates were starting to creep into the 5s.
Correct.
If I remember correctly.
You are right.
So we were starting to get back to, I wouldn't say historical average or anything, but we were starting to get back to maybe more of a normalized rate environment. COVID hit, of course, and we all know what happened after that. But so now that we're in 2022 and we've seen what's happened the last 3 months, especially with what the Fed has taken as far as action is concerned, but just where the economy is. Again, our goal with this conversation was really just to provide that context to say, yes, we see that interest rates have jumped up significantly. As far as the lending side is concerned, I'm sure there's some depositors out there who are scratching their heads going, and when is our turn coming up? I will just say in general that the excess liquidity that's been pumped into the system through the stimulus payments, while it was needed from an economic standpoint to help those who really were in need, the aftermath effect of it is that financial institutions and subsequently their members or their customers have excess deposits in their account. And now with inflation going up and whatnot, and the supply chain issues that we're experiencing, they're not willing to maybe spend that money as freely as we would hope in general. And so until we start to see more cash flow, just generic, or not, what's the word I'm looking for? Organic cash flow, spending on goods and services and whatnot, I think it's going to be hard pressed to say that rates on deposit accounts are going to follow what's happening on the lending side.
Yeah, there's certainly going to be a lag, and you touched on a great point. It's we always call it a flight to safety. People, they're going to hang on to their money now in case this continues or something else bad happens, and you can't blame them. I think we all do that. We want to make sure that we have the money there. So thinking about buying that new car or the house or doing some home improvements or whatever the case may be, those people who might be thinking, well, you know what, there's a lot of stuff going on right now. Things are more expensive. I think maybe we'll wait. And I think that's what we're experiencing, because we are seeing a slowdown in, for sure, the mortgage end. The mortgage volume has, really shut down. We're still getting some car loans because the rates are still fairly attractive there. But all in all, things have slowed down, over the time period. Just something I guess I want to touch on pretty much from where we're getting to the end of this podcast. I did again look this up, but I saw the average of mortgage rates and they started since 1974 up until today. And the average mortgage rate is 7.7%. So, that's just something to keep in mind. Obviously, we always want to get the best interest rate possible, get the lowest interest rate that we always want to do. But don't let that keep you out of, realizing your dream. If you want to be a homeowner, you can always refinance. And we have cycles. Rates go up, rates go down. Obviously, as Dave touched on, we were in a relatively historically low rate environment for 15 years. I don't know if we're going to see that again. I hope not, because that will mean that there's some pretty bad stuff going on in the economy.
Right.
But certainly don't go out there and say, "Well, I'm just going to do this and I can't afford it, but I'm going to do it anyways, even though the rate's at 7-8%. I don't care. I'm going to do it." But don't let a 5 or 6% interest rate discourage you from realizing your dream if you want to be a homeowner.
Well, I think Jerry brings up a good point as well. Is that when you book or when you take out a mortgage on a home or whatnot, yes, there are additional costs if you do ultimately refinance it, but you do have the option. Well, you should. Most lenders, they don't have it where you don't have a refinance option or whatnot,
Correct.
or like a prepayment penalty, which is not legal in the state of Wisconsin on mortgage lending.
Correct.
But you always have that opportunity, so that if we do end up getting into a recession in the next 6 to 12 months and rates start to fall back down, that's the time when you do consider, okay, well, does it make sense to refinance? Does it make sense to actually pay, some additional fees to refinance my loan at a lower rate over the term of a longer loan like that? You're going to make up for it, most likely. I mean, we can do the math for you, or we can always have that conversation with you if that's something that you're considering. But I would say if you think that you're going to hold off, to echo Jerry's point, if you think you're going to hold off because you're not willing to take a 5 or a 6% rate on your mortgage loan or whatnot, I wouldn't bank on the fact that rates are going to go back down in the next 6 to 12 months.
I would agree.
And you have the option at that point to take advantage of that. But I think to sit back and pass on maybe doing that home renovation or buying that new home or whatever the situation is, I think just for the purpose of the rates and hoping that they go back down, I don't know that that's necessarily the right move. Again, as Jerry said and alluded to, figure it out in the context of your own finances. If you think you can afford it or you can afford it, that's a lot different than thinking you may not be able to afford it because of the higher interest rate. So I understand all that, but
yeah, and I'll again piggyback on what Dave is saying. There's no right or wrong answer to this. I know we have a lot of our members ask me, well, am I doing the right thing? The right thing is what's best for you. You need to look at your cash flow. You need to look at your monthly cash flow. Is this something that you want to do? Is it something you need to do? So there's really not a right or wrong answer. It all depends on everybody's individual circumstances, and if this is the right time for you to do it, then go ahead and do it.
Absolutely. Well, if we could all predict the future, then
Yes. Well, I do believe if me and Dave could predict the future, that we probably wouldn't be sitting here right now.
Yeah, we'd be sitting on a beach in Cabo,
correct.
I think, right now.
I believe you're right.
Well, with that being said, though, I am going to make you put a prediction out there. What do you see happening in the next 12 months, 2 years maybe, let's say, for the economy or rates,
Sure.
Bringing it more specific to what we do?
Sure. Well, I do believe we're going to be, again, I hate to say if, but you do have to put this in here. If inflation continues to be an issue, which I believe it will, I think this is not going to be a quick, easy fix. Normally, I would say within the next year, we're going to start to see some normalizing, but more on the tail end of that year, year or month 8, 9, 10, 11, 12, so to speak. Just because usually when elections come around, that usually has that will usually sway things a little bit better. So obviously we have midterm elections coming up in 2022. Again, we don't want to make this into political, but it's just historically speaking. And then when there's a presidential election, then things usually normally get better. So I think we're going to see some, I don't want to say hard times, but I think, the gas prices are still up there. The Fed's meeting at the end of this month, and they're still thinking about raising another 0.5 to 3/4 points for the Fed funds rate. So I feel we're going to be in this situation for at least another year. And then again, if I wish I had that crystal ball, I could say it, but then we're just going to have to see. It all depends on what the market conditions are going to do and how they're going to respond to the Fed. If we're going to be able to, get the goods and services unlocked from the supply chain, so to speak. that's all going to have a big difference on it. So
Yeah, I agree. I think I'm not 100% confident that the Fed's going to be able to control inflation. I mean, I
Correct.
think they're going to be able to make an impact on it, but they're still targeting 2% inflation, and I think they're set to release that it's going to be like 8 or 9% still at this
Yes,
point, which
yes.
is again going back to the context of this conversation. When there was stagflation in the early 80s, it was 14%, I believe, was
yes.
the highest
Yep.
inflation rate we had. So not the highest we've ever seen, but it's significant. It is still high in the grand scheme of things. So I don't know that they're going to be able to do it, have enough impact on that to be able to do what they need to do. So I do see, I think it's probably going to be next spring to summer before they start to probably drop the Fed funds rate, I'm thinking, in order to
Correct.
try to spur economic growth or
we're
whatnot.
not going to. I don't think
but
we're going to see that soft landing. That they're.
I don't either.
Yeah. Again, these are just predictions by us, but you
Yep.
know.
Yeah, we're not economists.
No,
nor do
not
we
at all.
pretend to be one.
No, we didn't. Well, yeah, that's true. I think we're going to see that R word. I think we're going to, usually with this type of inflation and the Fed raising rates, we're probably going to see some type of recession that will spur the Fed into start lowering rates and get the economy back on track again.
Yeah. So again, as we alluded to just previous to this portion of the conversation, if you do decide to take action on buying a new home or financing something, we really just ask you, as a consumer, make sure that it makes sense within your own financial situation, because everyone's financial situation is going to be different. So even though we're thinking, okay, maybe a recession is on the horizon, don't let that deter you. Again, if you feel confident that your job's going to stick through a recession, or that you don't have any concerns from that standpoint, again, no one knows if that's actually going to happen or not. So to live your life in fear that's always on the horizon, technically.
Correct, right.
So
There's peaks and valleys throughout,
Absolutely.
and I think that's what we were trying to address here today. There's peaks and valleys throughout time. You have a great economic boom, and then you slide into recession, and then you get the economic boom, and then you slide into recession. So it's I don't want to say it's give and take, but it goes hand in hand,
Correct.
pretty much. And you're just going to see adjustments, and that's what we're trying to tell you. I guess reassure you in this day and age is it'll get better. We were due for this, I believe, just based on historical data. And
Right.
I think we'll come out of it. When that will be, we'll see.
yeah, hopefully
But,
it's not another 15 years.
yes, let's hope not. No, let's hope not.
Do you have anything else that you'd like to add just in the context of this conversation?
No, I don't. I just, like I said, please feel free to contact us if you got questions. We're more than happy to help you out and quote some rates for you, get you some payments that might fit your budget, or just questions in general. We're more than welcome to or willing to help you out with anything that you might have.
Well, awesome. Well, thanks for joining, Jerry.
Yeah,
Appreciate the
you
time
bet, Dave.
this
Thank you.
morning. And as Jerry said, you can reach out to the credit union. Visit our website, MMCCU.com. We have a wealth of information out there available to you, or talk to any of our experts. We're more than happy to assist. Have a good day.